For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Investing in shares today can be your gateway to financial freedom. To participate in the stock market, you need to open a CDS and a trading account. Here's a quick guide to help you open these accounts. A CDS account. CDS or Central Depository System account is fully owned and operated by Bursa Malaysia Depository. It keeps a record of the ownership and movement of shares traded on Bursa Malaysia. Simply put, when you buy stocks, shares are credited to your CDS account, and when you sell stocks, they are debited from your CDS account. In addition to a CDS account, you also need to open a trading account with a broker. A trading account is used to place your buy or sell orders in the stock market. Let us show you how to open a CDS account and a trading account in 3 simple steps. Step 1. Access Bursa Malaysia website and choose from any of the licensed stockbrokers listed on the website to open an account. Step 2. Once you have identified your preferred stockbroker, bring along your identity card and your bank documents to the stockbroker's office for verification. Step 3. Look out for a confirmation notice from Bursa Malaysia in your mailbox in the next few days. This mail will provide you with all your account details which you will use every time you trade. If you are new to the market and would like to learn the fundamentals of stock investing, please visit www.bursamarketplace.com. That's it! With these 3 easy steps, you are ready to start investing in the stock market and move towards achieving your financial freedom. Open your CDS account and trading account today. Happy investing!
Hello everybody! Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today, our topic is portfolio strategy put to work. Okay, as you know, portfolio management is a very important skill that will help us to determine whether we can grow get a return and grow our portfolio consistently year in and year out. So today we're going to look into how should we work out our portfolio so that can help us to get the kind of return that we desire. All right. So as usual, disclaimer is whatever we share on this webinar is only for educational purpose. So in no way that I give any recommendation to buy or sell any companies that if mentioned in this presentations. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. All right. So are you ready for this session? Portfolio strategy put to work. If yes, let me briefly introduce our speaker. Shasni often comes to our Bursa webinar to do the sharing in BM, but today he's going to do this in English. So Shasni is the founder and instructor at Equology. He is an investment advisor registered with the Malaysian Financial Planning Council as registered financial planner. Prior to founding Ecology, Shasni has held the position of a senior investment specialist in a wealth management firm, whereby he is responsible for conducting investment advisory and providing investment ideas based on in-house research views, in addition to providing portfolio construction service. So Shasni is also one of Bursa Malaysia invited speakers in providing investment education in the webinar series Bursa Economy. Shasni is also the speaker of the Share Investor and Investing Note invitation in the annual Invest 360 seminar. So hello Shasni.
Hi, how are you?
Good to have you here. Yeah, I'm fine. And you?
Great, doing great.
Awesome. So we can't wait to learn from you how to do portfolio management. All right. So without further ado, let me hand over a session to you.
Thank you. Let me continue my screen sharing. Okay, thank you so much, Shane, for the introduction. Nothing fancy also about the profile.
Oh, wow, you're doing amazing.
There are a lot of people are way more amazing, way more experienced. I believe some of the audience here also experienced investor. Probably you guys knows better than myself. But I try to deliver whatever knowledge that I could get from my years in the industry, how I observe institution or fund manager actually manage the investment, manage the portfolio, and hopefully I could convey the strategy, or if you rather say the steps or ways of building our portfolio, and try to manage it within our own risk tolerance. Because in the end of the day, the core of our investment management, right, is actually the risk management. That would determine whether we could ride any market trend, any volatilities, any uncertainties in the market with ease, okay, with calmness, with peacefulness throughout our investment journey. That is the most important thing in this topic today. So
yeah, that would be very helpful.
Right, sure. And yes, back to our agenda, right? That's why I try to list it down according to this flow. First, we're gonna start with ideal breakdown of portfolio, because oftentimes people will ask, how do I build a portfolio? I don't know where to start. So I will show you the ideal breakdown, ideal way to start, how to break it down, and then I will show you some examples on how this portfolio strategy could limit the downsides and also the fluctuations. And I could show you some real case study based on some website or some tools that you can use to see the usefulness or the effectiveness of portfolio strategy. Okay, first thing first, why portfolio strategy? We always get this question from investor saying, stocks is simple, right? Investing in share is simple. It's either go up or go down. That's it. And then if you want to cater for you want lesser risk in your investment, you invest long term, because anyhow share price will curve upward, will go up. But then people often mislook or misunderstand about share price movement. Yes, though in long term the share price will tend to curve upwards. We are talking about a good share, a good company, a good businesses, stable business. The share price will usually tend to move upwards, will curve upwards, either steep or gradually. But then we often forget, investors often forget that actually within that upward curve is actually made up of a lot of fluctuation, a lot of up and downs. Like how you can see the actual share price here. Yes, though in long term it curves upward, but then within that upward curves, there are a lot of up and downs. And it compares to what investor usually imagine, is like a straight line. That is one of the misconception or myths that usually investor has. It's actually depending on whether you view it from the short-term volatility or you want the long-term gain. And then why the fluctuation is there? What creates the fluctuation? What creates the up and downs? Is actually the business cycle. Essentially, right, when you invest in stocks, when you invest in shares, you are actually sharing the equity. You are actually sharing a piece of the pizza, a piece of a pie of the company. That is also one of the thing that investors usually mislook or tend to ignore. When they invest in stock, either, let's say if you speculate, you buy at 1 ringgit and you wish to sell it at 2 ringgit, without knowing that essentially what are you actually buying. In shares, as the term describes share, what are you sharing? What is being shared is actually the holdings, the part of the pie, the piece of the pizza. So what determines the value of the piece of the pie that you are holding? That one is actually depending on how valuable the business is. Company stocks is issued by a company, and what actually drives a company is the business. So if you want to invest in stock, you actually should look at how attractive, how well the company run the business, how well the company position their competitive advantage in the business among other competitors. So as you can see, business cycles, they are up and downs as well. They are expansion phase. Sorry, let me change the pointer. There's an expansion, and then the business will go to the peak. That's where you see recession coming in, and then depression to the lowest point, trough, and then they recover back to a new cycle again. All of these establish a long business cycle, and then if you were to break it into half, that would be the short-term business cycle. This will directly reflect into the company's earnings, the company's revenue, the company's net profit. In any businesses, there will be a business cycle. So whenever the business is in depression or trough period, you will see the earnings, the revenue will tend to be slightly lower as compared to expansion or peak season. Most of the business will have its own cycle, and I would say one business that you could imagine with no business cycle is probably the closest example I can give is F&B. For example, Nestle. You will see usually Nestle business, I would say, is the best example for a stable business, stable income, stable revenue. You can refer to Nestle as one of the best example. If you were to give, take an example or a company as the benchmark for stable business, for stable revenue, you can I would say comfortably select Nestle. All right. So the price, the fluctuation is actually derived from the business cycle, the up and downs. If I put the share price and the revenue as well as the profit margin side by side, you can see that actually the trend is about the same. It's pretty much similar. Whenever the company is experiencing a slower revenue period, you will see the share price will also follow. And whenever it recovers, the share price will also follows. So if you notice, right, if you were to observe a company whenever they recorded extremely high revenue, out of expectation revenue, out of they exceed the expectation in terms of their net revenue and net profit for 2 consecutive quarters or more, you tend to see the share price would be highly in demand, whether by institution, by retails, because people notice that, wow, probably this company is doing good, probably their business is doing very well. And if you look further into it, probably you will find the management giving some message in regards to they are gaining market shares, they can control their costs, for example, and or maybe some of the competitors got kicked out of the market, for any reason that could drive up their revenue, that could drive up their net profit. You will see for, let's say, 2 or 3 consecutive quarters, the price will definitely usually will follow through. So there's a saying in value investing, don't invest in the price, but you invest in the business. That's the profitability, the earnings. Buy the earnings, don't buy the price. Okay, and with that, why you need a portfolio is because sometimes we couldn't tell how steep or how huge or how big, how significant is the fluctuation, is the volatility. Actually, in portfolio strategy could directly address this problem. I'll show you one example. If you notice, in any market situation, right, there will always be a winner and a loser. Trust me, if you are a veteran investor, I think you have gone through more recession cycle than me. And the closest, the latest recession that I believe all of us experienced was the COVID-19 downturn. Okay, during that time, we could see healthcare and financial fare totally differently. They went totally in 2 different directions. For healthcare, because it is one of the most beneficial sector during COVID. As you can see, this is the index, how the index fared as compared to financial, because of interest rate has been lowered to a very low point, so it affects the bank's profitabilities. So you can see index for financial went down. So in this case, healthcare will be the winner and financial is the loser. So if you look back during 2008, subprime mortgage crisis, if you look back in 2000, the dot-com bubble, you could also tell who was the winner and the losers during those time. And how long do we think back then during COVID time, during early 2020, how many of us could predict how long the downtrend is going to last? I don't think anyone could predict, because based on historical data, statistical record, the shortest period for recession range between 3 to 6 months, and then the longest it lasted for years. But then no one could tell COVID lasts less than a month, and then it recovered, went back up past the pre-COVID level in less than 2 months, 1 month plus. No one could tell. Some people told me, "No worry, this one will last at least for 6 months, because we have no technology, we have no medical advancements to fight COVID. So I will wait for 6 months at least before I take any new position, or before I average down." but then it lasted for less than a month. I mean, it recovered in less than a month or 2 months. And then if you were to take position in healthcare at this point of time, you can see healthcare fed downwards later on, shortly after, and then technology fed up, like because it's one of the least affected sector during COVID. So these are the winner and loser during COVID. So how do we manage the risk on probably misselected the sectors or misallocate our portfolio, misdiversify our portfolio? So one of the advantage of portfolio strategy is that we could cater for different area in the markets, different sectors, different industries. And if we were to face this example, you know, both sectors went into a different direction, technology and healthcare went into a direction, at least we allocate a fair share, a fair percentage in each of these sectors, and hopefully with even one sector drop and another sector went up, at least it could balance up our return, our overall net profit and loss of our portfolio. So that is the key advantage of portfolio strategy. Now I'm going to show you like what do you have to know first before you build a portfolio, which is your risk profile. This is the question that a lot ask. How do I start? How do I build? So it's actually the core what determines your portfolio is actually your risk profile. You should start from understanding your own risk tolerance first before you build a portfolio. So this is a saying, word of wisdom when it comes to investment. Don't put all eggs into one basket. It's obvious, because if you only put in one basket, if that basket drops, all your eggs will spoil. But then if you split it into a few different baskets, one drop, you still have 2 or 3 more that you can utilize, that you can use. Similar to portfolio strategy, how to build, how to split it, how to spread your risk is actually based on your risk tolerance. So I believe if you have agents or consultants that are serving you, most probably they will let you do a risk profile questionnaire. They will request you to answer a risk profile questionnaire, and that questionnaire will ask, let's say, your how much is your salary, how long your savings could last if you're out of income, how many of your dependents that actually depending on you, and then is your current salary, is your current income stable or unstable? So those are the questions that you need to answer, and then the result from the questionnaire will tell whether you are a conservative investor, moderate conservative, balanced, moderate aggressive, or aggressive. Usually risk profile will be divided into these 5 main categories. So what differs this risk profile is actually the allocation in equities and bond. It's actually not necessary must be equities or bond. It's actually depicts the idea of one portion is for higher risk element, and then another one is for less risk elements. So usually people will insert equities. They will buy equities, and then another part is bonds or bond funds, those that are relatively more stable. The purpose is to instill a stabilizer, to have a stabilizer element in your portfolio. Equities is very volatile. It could went up, a double-digit percentage, and then could went down also as much. But if you have a stabilizer, a bond fund, usually the return is ranges between 4 to 6% a year. It could stabilize your portfolio volatilities. So even if your equities fluctuate up and downs a lot, when you have a stabilizer element in your portfolio, you won't feel the volatility, eating up a lot of your portfolio return, or it contributes, give you like the instability, or could trigger your emotional during investing. Those are the I would say the drawbacks that could be that could come from the volatility from equity sides. So it's important actually to input a stabilizer, or I would say something that is more that will go up gradually, something more stable that could balance up your portfolio volatility. Some will ask, why not I just put 100% into stocks, because I already diversify it. Yes, even if you buy, let's say 10 stocks, but you won't know whether how significant the fluctuation is going to be. Though only 10% of bonds, or the less riskier assets, it could actually bring a significant I would say a stabilizing element. It could help a lot in your portfolio actually. I'll give you an example which really closely related to managing a portfolio, which is like managing a football team. In a football team, you want a formation, a team, a strategy that could give you the victory. You wouldn't want to form a strategy, or to to play all your players in the defending area. You don't want to play all 11 players as a defender. Why? Because you couldn't win, because no one is going to score the goal, no one is going to attack and score goals. Yes, chances for you to concede is much lower, but then you wouldn't score as well, so you couldn't win by just defending. Unless your goal is only for you are targeting for a draw, then it's fine. Let's say you already have millions in your account, and you just put in FD, they're going to give you also a hefty return every year that you could live live out of your job. You could retire peacefully, you could retire at ease with a few millions in your FD. If that's your target, then it's fine. You can play every player in defending area. But then if you are if you're younger, you want, let's say 7 to 10% return at least a year to compound your portfolio return in order to achieve your retirement target, your investment objective, for example, then you couldn't play this strategy. Reversely, you wouldn't want to play every player at the attacking side as well, because chances for you to concede is equally high. You could score up to 5 goals, 10 goals, even 20 goals, but then you could also concede as much goal as well. So there are no defensive line, chances for conceding are very high. So you want a strategy, a formation that could control the entire field. You have defenders, you have midfield, you have attackers, and then you want a strategy that could be changed when if necessary. Okay, and then you want to substitute a player if necessary. For example, you notice that when the first minute into the game, you notice that wow, your opponent is something, they are very strong. So you want to play a more defensive strategy. Probably you want to allocate one more player in the defensive line. And let's say you notice that wow, our strategy works, we can fight this opponent. You want to allocate one more player as the attacking. You want to play a bit more aggressive. in the context of investment, it's the same. During market uncertain or very volatile, you want to be slightly defensive. During risk-off period, you want to be slightly more defensive. Let's say you are an aggressive investor, from 10%, right? You probably want to allocate 80-20. And if you are moderate aggressive, 70-30, or probably you want to allocate 60-40. Remember the allocation earlier? And reversely, during market risk on period, means there are a lot of opportunity in the market. Equities, it's relatively more attractive than bond market. You want to be a little bit more aggressive. You want to allocate slightly more into the equities element. So this is analogy about portfolio strategy, about portfolio management, is pretty much similar as compared to managing a football team. Okay, now we go into creating an ideal portfolio. How is ideal? What is ideal? First, you have to diversify based on asset classes. Asset classes means equity, bond, ETF, unit trust. These are asset classes. So you want a portfolio with a few different asset classes based on their purpose. Equities or share or stocks, these are the alpha generator. These are the striker, people that are going to score the goals for you, because these are the asset classes that is potentially could potentially deliver relatively higher returns. So we want to allocate this portion. We don't want to ignore. We don't want to totally exclude equities, even though you are a very conservative investor. Okay, because these are alpha generator, how we call it. And then we want to input unit trust. The purpose of this unit trust is, let's say you are not well versed in overseas market, for example, US or China, and even to access to this market, probably the required capital is slightly higher, and then you have to understand the market, you have to understand the regulation, understand the business in other country. So let's say you don't have the capacity to do that kind of analysis, to do that kind of due diligence, to do that kind of research. You could always invest in unit trust or ETF that invest in that particular market. For example, unit trust that invest in China, unit trust that invest in the US, ETF that invest in the US. You can always leverage on these asset classes in order to have the exposure in those particular areas. Remember, we want a strategy that could control the entire field. That in investment context, we want a strategy that could control the entire world. We will want allocation in few different parts of the world. I will explain why allocation based on geography, based on country, equally important. And then we want bonds or bond fund. These are the stabilizer element, the elements that give that balance up, that stabilize our portfolio volatility. And then others, you can always input things like, since it's small, relatively small portion, right? You could imagine you invest into something like gold or crypto. Those are very risky, but then you want to control the risk by allocating a very minimal amount in those asset classes. So you can allocate according to your risk profile. For example, conservative portfolio, 70% in bond, unit trust, 20%. Let's say it's a combination of US equities, China equities, and Malaysia bond, for example. 20%, and then another 10% is stocks. Even if you are really conservative, right, you could invest in dividend stocks. Yes, the price might they'll still fluctuate, but might not fluctuate as much as, for example, a small cap stock or a technology stocks, for example. So you could invest in dividend stock and then leverage on the dividend income, for example, for conservative portfolio. And then for aggressive, as you can see, 20% in bond. Let's say you allocate 80-20, right? 20% in bond, 30% unit trust, maybe in China or US, 40% Malaysia stocks, and then 10% maybe in gold, for example. These are the actual diversification that we are that could be considered as an ideal portfolio. And then number two, we want to allocate based on geography, based on regional. For example, we will want a certain allocation into a developed country, for example, US, Europe, Japan, and then emerging market, China, Asia, Brazil, Russia. These are emerging markets. And then I would recommend like a thematic allocation. Thematic allocation means I think everyone knows recovery play during COVID downturn, right? Recovery play used to be one of the famous, one of the main theme that people recommend, people keep talking about, because a lot of the assets, a lot of the stocks were undervalued back then. So recovery play has been became a thing that people recommend. So thematic allocation, you could leverage on a thematic allocation, but if you are not a fan of theme, trend, or some I would say a trend. If you're not a fan of trend, you could always ignore this. You don't allocate according to thematic, but allocate based on your own preference. These are just an example of how you could allocate based on regional or based on geography. And then the small least portion is dividend stocks. Okay, when it comes to the practical part, the actual strategy exercised by fund manager, the institutional fund manager, I will give you an example of EPF Portfolio. This is a summary of Q1 result for EPF, and then on the right side is the second quarter of EPF performance. So if you can see from here, EPF portfolio consists of equities, as like how we see in earlier slides. Equities, fixed income. Fixed income is actually bond, and then the less significant money market instrument. Money market instrument is because EPF they must set aside a certain amount of liquidity. They must set aside a more liquid portion in order to cater for sudden withdrawal from participants, from the members. So money market usually to cater for sudden withdrawal, and then they have around about 4% in real estate or infrastructure, not significant. If you look at equities, 44%, and then fixed income, 46%, we could say that EPF actually exercise a balanced kind of portfolio, a balanced risk profile, in order to be able to deliver 5 to 6% a year for the members. They practice a balanced portfolio, 44%, 46%, so that they could target 5 to 6% return a year. But then that's not the main point. The main point that I want you to see is from the income part. If you can see Q1, first 3 months of 2021, equities deliver about 14 billion of income to EPF. And then fixed income delivered about 4 billion. And then moving into second quarter, they still remain the same allocation for equity and fixed income for bonds. Means there's not much changes being done in terms of allocating between both assets, still the same. but then only the income differs. Equities dropped, contributed only 7.8 billion as compared to 14 in the first quarter. But then if you notice, the bond element actually delivered higher return, 5.28. If you link this to the overall market in the first 6 months of 2021, we can put a lot of things into pictures, right? A lot of uncertainties, a lot of market surprises, market events into pictures. For example, we have the Delta variant, and then we have the China interfering their major players, businesses. And then we have Evergrande issues. We have US Federal Reserve talking about tapering. And then closer to home, we have political uncertainties. A lot of things happen within the first 6 months of 2021. But then, though equities fluctuate, went down a bit from 14 billion to 7 billion. But as you can see, bond side of thing actually increased from 4 to 5. So that's the main purpose of these asset classes. Whenever the equities fluctuate, the fixed income will play its part, will play the role of a stabilizer, will stabilize the portfolio. You are not incurring losses, it's just that you earn lesser. That is the main idea of portfolio strategy. I still remember this word of wisdom that I always carry until today. During my earlier time in the industry, my mentor, my first mentor, my manager used to tell me, in investing, in managing investment, in managing portfolio, you actually manage the downsides and let the upsides fly. You get what I mean? Managing the downsides, but let the upsides fly. You want to manage the potential downside, the risk, so that your performance, your portfolio return wouldn't drop significantly, wouldn't fluctuate, or wouldn't when soft significantly. But then, how much upsides that the market could deliver, you just take it. For example, in Malay term, we say that is rezeki. How much the market want to give us, that's our rezeki. That's how much markets could deliver. We just take it. If 10%, then we take 10%. If 15, we take 15. But we don't want the portfolio return to drop significantly. So we manage the downside. We let the upsides fly. That's the main. It's supposed to be the main focus, the main objective of you practicing or exercising the portfolio strategy. So key thing to note, equities and fixed income usually will exhibit negative relationship. They have close to zero correlation. Means whenever one go up, usually another one will go down. So you could see this trend repeating over and over again in the market. Whenever there are a lot of uncertainty in equities in the market, people will move their capital to the bond, the fixed income instrument, Federal Reserve. The federal bond, the US bond, Treasury bond. And then whenever equity markets poses some opportunity or some optimistic picture, people will move back their equity, their capital from the bond market to the equities market. So diversification by asset class is to establish the element of stability and calmness in our portfolio, despite riding through wavy, uncertain market situation, like how EPF did. In the first 6 months, they did not change their allocation, and that still give them a reasonable return, reasonable income, investment income within the first 6 months. Okay, now I'm going to show you the actual calculation and how it could affect your portfolio return as a whole. you make an assumption, okay, a portfolio value worth 100,000, and you exercise 80-20 portfolio allocation, portfolio breakdown, 80 in stocks, 10 in unit trust, another 10 in bond. So stock 80,000, unit trust 10,000, and then bond is another 10,000. Give a situation, say stock performance falls by 50%, and then unit trust goes up by 20%. What is your portfolio return? Stocks we allocate 80%, right? So what is your portfolio return if this portion drop 50 and the other 20% goes up, the other 10% goes up by 20? This is the calculation. Stock 80%, profit loss drop 50. So your overall portfolio return for this stock segment is negative 40%. And then for unit trust, since you allocate only 10%, this portion went up by 20%. So overall, you get 2%. So net profit loss of your total portfolio is negative 38%. First example. If I switch the situation, I switch the context, say stock performance went up by 20%, and then unit trust went down by 50%. What's your portfolio return? Same, 80% into stock, went up 20. Your overall return for this portion is 16%. And then unit trust, since you allocate only 10%, even if you drop 50%, the overall return for this segment is only negative 5. So your total portfolio net profit loss, you still have 11%. So the key things you need to remember is the bigger the allocation, the impact on performance will also be more substantial. 80%, there's a difference between 80% in one stock versus 80%, let's say, in 5 different stocks. You will experience a different level of volatility. You will experience more significant volatility if you invest 80% in one stock. So it's important for you to ensure you want to always consistently making a profit while at the same time controlling the risk that you are exposing to your portfolio. So if you allocate too much percentage allocation in one element, you might want to further diversify that portion. For example, 80% into stocks. You don't want to invest only one stocks or 2 stocks in that 80%. Try to spread it out, spread the risk out. Try to practice diversification across sectors. For example, if you invest 80% in Malaysia stock, try to diversify by sectors. 1 stock in transportation, 1 stock in maybe 2 stock in technology, 1 stock in industrial, for example. Try to diversify across sectors, because different sector will also possess different level of correlation. This one, you want a diversification that have as least correlation as possible. If the correlation is equal, let's say correlation is equal to 1, means they will fire in the same direction. So you don't want that kind of diversification. When we say diversify, means we want 2 assets or 2 sectors or 2 businesses that really does not correlate between each other. Okay. So this is how your portfolio will look like if you invest in, let's say, in only 1 stocks. If the share falls by 50%, this is how your performance will look like. Will drop as much, 50%. But if you only allocate 10% for the stocks, if the stock fails 50%, your overall portfolio will only be impacted by 5%. Simple example, straightforward example. Let's say 100%, you invest in 10 different stocks. Each stock contribute 10% of your allocation, portfolio allocation. even if the stocks fall by 50%, that stock only, your overall portfolio will only drop by 5%. So imagine if the other 9 stocks, let's say, went up by 5 or 10 or 20%, that could actually balance out your loss. So maybe your overall portfolio wouldn't be as the loss of your overall portfolio wouldn't be as bad. Okay, now we look into geographical allocation. Just now we have went through asset classes, right? Now we go further into geographical allocation and why is it important. Back with the football team strategy, we will want a strategy that control the entire market, right? The entire world. We also want to take advantage of different countries, different economies, because these economies, they have a different dynamics, different different base, I would say. For example, you couldn't compare a US economy with China. You couldn't compare US economy with emerging market or with Asia market. Why? Because their economy actually driven by different dynamics. US market is basically a combination of services, mainly contributed by services sector, by financial, and then for example, China market is a combination of manufacturing and service. For example, Malaysia market, for example, the small cap segment of Malaysia mainly contributed by export-based player, means they get their investment from other countries, from overseas countries. And then economy like emerging market, for example, Brazil, Russia, North America, these are the countries that derive their income based on commodity, oil, soybean, coffee, commodity-based economy. So you couldn't compare this market using apple-to-apple comparison. So that's why when you look at the index return, right, from year 2003 until 2020, you could see all these market will have different return, different performance, which will record a different level of performance, except for certain years, which is a little bit biased. For example, 2008 during subprime mortgage crisis, you can see all these countries recorded a loss. And then 2018 also, all these market recorded a loss because of US and China trade war. But during normal years, normal time, these markets actually fared quite differently. Some high, some low. For example, US and China during 2003, and then during let's say 2014, China 51%, but US 11%. And then 2017, for example, a good year. Asia basically dominate the market. Asia ex-Japan, emerging market actually dominate the market. US 19%, China A 21%. Because of the diversity, the difference in dynamics, what drives the economy actually reflects in these differences in terms of the performance. So you want to diversify your portfolio to cater for all these geographical area, all these countries, all these parts of the world, so that you could take advantage of the performance. Let's say if you invest in only one country, only in Malaysia, only in China, only in US, whenever the markets take a hit from any market surprises, your portfolio will also be affected. For example, if you invest 100% into China now, I believe you would see your huge sum of your profit wiped out, or even your portfolio might be probably at loss now if you invest everything in China. Okay. So how to diversify according to country, according to geography? One way of which most of the fund managers did is by referring to the world GDP weighted. Last time, a lot of the funds, a lot of the collective investment schemes as a whole usually will use MSCI World as the index. MSCI World as the index, as you can see in the index, more than half actually contributed by US, because MSCI World is actually using the market capitalization to measure all these size, the country's contribution towards the index. So if you refer to market capitalization, if you refer to the economy size, right, you would definitely see a huge bias here, because US market, the size of US market is the biggest. So let's say if you were to plot your portfolio, build your portfolio based on MSCI World Index, you will have a very overweight allocation into US, more than 50%, 52%. And then if you look at China, the blue one, the lighter blue one, only 4%. Logically, if you compare, if you think, if I allocate only 4% in China market, would my portfolio actually represent China's potential? No, because China economy, China market is actually contributed a lot in terms of the market return. So a more rational options that you should go for is referring to MSCI World GDP weighted. This one is actually constructed based on the GDP of each country. Based on this GDP weighted, only we could see your allocation is a bit fair, a bit rational. US contributed about 26%, and then China contributed about 19%. Now we can see it's like it's much better, much how to say, correctly represent the market, the current market condition. And one more thing is, it actually reflects the current state of the economy, the current state of the market, the countries. If you refer to the market size, this is like you are actually using a historical data. You are actually using an outdated data. You can only tell based on size. These are historical. You couldn't predict what will happen in the future based on historical, but you could project, or you could forecast what will happen in the future, the potential of the future, based on their current GDP position, their current GDP how to say, performance. If China, the size is much smaller than US, but then if you base on how much the economy could deliver, how much the economy could perform, it's actually quite a huge sum, 19%. So if you want to build, if you want to diversify across country, a better representation is actually based on MSCI World GDP Index. We refer to the GDP of these countries. Okay, and yeah, this is what I'm trying to convey. If you look at US and China market, if you're solely looking at the size, the market capitalization is, definitely you couldn't compete with US. But if you refer to the growth, if you refer to the potential, the prospect, the growth of these economies, China is actually closing the gap between with the US. The growth is much steeper. If you look at the curve, China's curve is much steeper, and actually is closing out the gap in a short span of time. That is the key, in a short span of time. From 2015 until 2020, 15 years, China could keep up with US economic growth. Okay, so we have gone through risk profile, how to measure your risk tolerance, and then how to start building a portfolio, how to allocate based on your own risk tolerance, how much we allocate in equities, how much we allocate in bonds, and then how to allocate between asset classes, and then how to allocate within geographical area. Assume that you have built an ideal portfolio, an ideal diversified portfolio based on your own risk profile and your own risk tolerance. You have found a strategy that suits you, and then you consistently keep to that strategy with a lot of disciplines, with a lot of consistency. And I want to compare between these two portfolios. Imagine this ideal portfolio is your portfolio, and then another portfolio on the left is a portfolio solely to maximize return. For example, this is your friend's portfolio or your neighbor's portfolio, for example. They invest aggressively into high risk asset classes, be it stocks or be it crypto, for example. And then yours, you have stocks, you have bonds, very ideal. Your portfolio only deliver 9% a year, but very consistent. And then because you have that stabilizer element, whenever the market drops in the 7th year, your portfolio drop only 10%. But if you refer to another portfolio, first year until the 6 years consistently deliver double-digit return, more than 20%. But during the 7th year, let's say this is the COVID year, drop a lot, the portfolio dropped 80%. Despite the same starting point, 50,000, but your portfolio is actually recorded a profit of 50%, and the portfolio on the left recorded a loss 20%. Almost achieved 200,000 on the 6th year, but then on the 7th year, wipe out all the profit and then drop by 20% some more. So a good return, a high return is not the thing that you should focus on. What you should focus on is actually whether the portfolio could deliver consistency to your returns, whether the portfolio could deliver a stable return, and whether that portfolio could give you a sense of calmness, a sense of stability throughout your investment journey. Because investing is not short-term speculation, it's not gambling. Yes, you might be in a good luck, you consistently making 20, 25, 20, 30% a year for 6 years straight. But 1 year of a huge downtrend could actually wipe off all your investment. So from here, you could see actually the consistency and managing the downsides, like the one that I mentioned, told by my ex-manager, my mentor. Managing your downsides and let the upsides fly. You could manage within 10% drop, but the upside is only 9%. But in long term, with that consistency, with that stability, you could still win the game. Okay, because investing is supposed to be a long-term process. It's actually a journey that requires a certain amount of dedication to manage your portfolio. So try to look for an ideal portfolio breakdown, an ideal portfolio diversification. Try to understand your risk tolerance. The 5 category of risk profile is actually, to me, is actually a theoretical guide. But then the actual risk tolerance is actually measured when you are in the market, when you start investing, when you already invested some amount of money, you invested some amount of your capital, and then actually experience the market volatility, the market downsides, and experience a best time in the market. the actual risk tolerance, your actual risk appetite is actually measured by that, your experience. A lot of investors that I guide, yes, they could easily understand risk profile, they could easily understand allocation, they allocate very well, but then during downturn, during volatile market, during uncertain market, they will still call back. Suddenly, how should I allocate more into bond, or should I sell? Despite already having an ideal portfolio, they will still ask. So the actual test, the actual the actual challenge to see whether or not you are in that category, in that risk profile category, let's say aggressive, to actually measure whether you are aggressive investor, you have to go through a very rough market, a very brutal market. If the market drop 30%, if your portfolio dropped 30, 40, 50%, for example, how would you react? For an aggressive investor, you should react relatively more, less panic as compared to a balanced or conservative portfolio. But if you couldn't, then you might reassess your risk profile. Probably a moderately aggressive one should be more suitable for you. Might not be balanced, but maybe moderately aggressive should be more suitable. So these are the art, I would say, the beauty, the art of risk profile, of risk tolerance. But you wouldn't want to risk your capital, you wouldn't want to risk your money to understand your risk profile based on after you've gone through the rough market or the volatile market, lost all your money, or let's say lost a huge sum of money, then only you go to finding out what is the ideal portfolio. That's a bit risky. To me, try to find out what is the ideal portfolio first, then only you go you go right into the volatile market. At least you already have some preparation. At least you have some strategy to minimize the loss, to stabilize your portfolio. Whatever happened in the market, at least you are in a safe hand. This is a more recommended way to start investing. Try to have a portfolio first. And one fact about portfolio investing is that people usually will ignore this topic. People usually will ignore a few topics, which is very important. Portfolio strategy, managing your emotions, and one more is about risk management. Basically, all these are within the risk management chapter, but tend to be disregarded, tend to be ignored, or tend to be less favorite topic for investors, but it's a very important topic. So if you want consistency throughout this process, stability in the portfolio is key. And if I could relate why portfolio managers, all these institutional managers, yes, though they are not managing their own money, they are being paid by salary, they are being paid by commission to manage these funds, manage these schemes. Why they could be stable, why they could calm, why they could still go out and give briefing to investors. Oh, we think our portfolio is doing pretty well. We think next year will be a more more positive year. Why they still could be so calm, go out and still telling people about the potential, and then still calmly answered all these questions from all these panic investors, is because of they have a strategy which really have a stabilizer in the portfolio, really have an element in the portfolio that could stabilize their return. With that, I think I've come to the end of my presentation. And what time is it? Sorry, 9:40. Shane, maybe can you allow me maybe a few more minutes for me to show and
Sure, go ahead.
tools, portfolio tools.
No problem. Go ahead.
Okay. Hang on, yeah. Okay. All right. If you want to try it out, you can go to this website, portfoliovisualizer.com. Is it portfoliovisualizer.com? Yeah. You go to this website. This portfolio visualizer actually is a very comprehensive website. It's very comprehensive tools for you to see how effective or how useful portfolio strategy is. I'll demonstrate an example for you. For example, we select a start year of 2020 until 2021. Year to date, yes. 10,000 cash flow. Okay, let's say put none. Rebalance annually. Dividend reinvest. Okay, all right. But this website only cater for US stocks, US market. So let us quickly build a portfolio. Let's say I want to include Apple. F&B player. Let's say EMB. A more volatile one. Oh, not here. Okay. Maybe Procter & Gamble. Home Depot. Okay, let's say I build a portfolio based on these 5 stocks. Okay, and this is the allocation. Let's say I put 30 in Apple, 20, so 20. Okay, and let's say 25. That one. Yeah. Okay, so 3 different allocation, 5 similar stocks, analyze portfolio. This website will let you see a lot of information, a lot of statistics based on, for example, the drawdowns. This is one good thing that you could utilize. For example, during 2002, these are the biggest drawdown for these stocks. For example, portfolio 1, the length of the biggest drawdown is lasted for 2 years and 9 months, which was from 2000 until 2003. This one. Let us see how these portfolios, how these stocks actually perform during these years. You could go to annual returns. Yeah, 2000, 2003. Overall return, portfolio 1, 30%, drop as much as 30%, 23%, portfolio 3, 34%. So if you experience this kind of volatility, would you exit the market? Would you drop out of the market? For example, if you invest only in Apple, if you don't invest in the other four, once Apple stock dropped 71% during 2000, and because that you have a lesser volatile stocks, for example, like Coca-Cola, Home Depot, though, for example, AMD dropped only 4%, KO went up by 6%, is actually helps you to pull up your portfolio returns from one portfolio dropped 71, and then overall you only drop about 23 or 34%. Imagine you invest everything, you very narrowly focus into only one stocks, your overall volatility of your portfolio will be much bigger, much significant. And then let's say we compare another year which is a very good year. Yeah, for example, 2004, Apple went up by 200%, and then the rest are double digit. AMD went up by 47%, but Coca-Cola dropped by 16%. This is the thing that about the correlation that I mentioned to you. Different sectors will have different correlation. Some will have much lower correlation with one another, and some don't. So, for example, during tech stock drop, sectors like F&B, like Coca-Cola, was not affected. But whenever the business cycle benefit the tech stocks, you could see players like Coca-Cola, like F&B players will experience a downturn. That's the zero correlation or lesser correlation that I was talking about. So in 2004, your overall portfolio increased by 71%, 64%. Some people will say, oh yeah, if I invest 100% into Apple, I probably get 200%. Why don't I invest everything into one stocks? Back, if you still remember EPF's results, you don't your profit is only lesser. You don't incur losses, but your profit the profit that you record is lesser, but you are still making money. You are still making profit. This is what I'm trying to say. During that year, yes, you still make 71%. Your portfolio is still up 64%, 77%, but you are not actually, you're only earning lesser. You are not actually incurring losses. Try not to be greedy, because portfolio strategy does not benefit you in terms of that. Yes, you are better off investing 100% into stock that went up 200%. Yes, you could be 200% richer if you invest everything into it. Portfolio strategy does not cater for greedy people. You earn lesser, but then during volatile market, during negative market, you lost lesser. That is more important. And then other feature that you could use in this website is metrics. I know. Yeah, this one. In summary tab, you could see worst year, best year, maximum drawdown, and also the Sharpe ratio. The higher, the better. And then the KGA. So worst year, drop 39%, 44%, 36%, which was during 2000. And then best year, 124, 151. This was during 2009. 124, 151, 97. Okay. You could play around with this website, with this tool for you to understand, and then you could change the stocks. You change around the stock, change around the allocation, and then see how your Sharpe ratio your risk contribution, try to play different kind of stocks, different sectors, and then and see how your risk adjusted return plays out. Okay. Yeah. With that, I think I'll end my my presentations.
All right, thank you so much, Shasni, for very wonderful and detailed presentation on portfolio management. Yeah, so if you have any question for Shasni, you may write in the Q&A box and we'll address them accordingly. So first question, Stephen Fu would like to ask, how do we construct a geographical portfolio based on the current market and future condition? Regions to be inside our portfolio include China, Asia, emerging market, developed markets, US market, Malaysia market, question mark.
Okay, yeah, I think back to, let me share the screen again. Oh, sorry, not this one. Back to this slide. You want to allocate based on the GDP weighted instead of the market size. If you refer to the MSCI World, which is an index used by a lot of the fund managers, you will have an overweight allocation into US market. You don't want that. Why? Because China economy actually contributed quite a huge sum in terms of their performance, in terms of their return. So, and based on take into account their potential, their prospect, you will also want to allocate a reasonable sum into China market. A rough allocation that I could simply give you now, though there are a lot more considerations should be made. For example, if you allocate 80% into equities, Asia, China, US and China should be the top two biggest allocation in your portfolio. For example, 30% in the developed market, US, Europe, and then 25% into China, 20% into Asia. Yeah, these are supposed to be your the top allocation in terms of geographical area. I couldn't give you an exact percentage because that requires you to recognize your risk profile, your risk tolerance, how many percentage that suits you. Then only we further break down that percentage into different markets. But as I said, US, developed market, China, Asia, these are supposed to be contributed relatively more as compared to other markets in order to cater for this as well. Okay, even if you look at the GDP weighted, the huge portion, US and China. Others include Asia, of course.
Okay,
right.
Thank you so much, Shasni. Shafiq would like to ask, just now you mentioned that we can invest from the bottom. Can you share how can we identify counter that already reached the bottom price? Because low price can be lower, which is something that we cannot predict accurately. So how can we manage this risk?
Can you share on how we can identify the counter already reached bottom price? Okay, it goes back to your way of investing, whether you are investing based on value investing or you are based on technical. Let's say you're a chartist. Value investing, definitely you will utilize margin of safety. And let's say if you are utilizing technical analysis, there are a lot more indicators that you could use, either moving average, and then refer to pair up with other indicators. To answer this question correctly is about how well you understand the business. If I were to answer it in a better context, whenever you invest in stocks, you should understand the business, because from there you will know when the business is in downtrend, is in the trough cycle or the recession cycle, and then you will also understand in reverse when is the expansion cycle, recovery, expansion, and the peak cycle. So it goes back to understanding the business cycle itself, understanding the business itself, and how the company actually position their business in the market, in the industry. Let's say the current business cycle is sitting at trough, really at the bottom, and the company is really not making money. Not to say not making money, but making lesser revenue or lesser profit. Okay, you recognize that as recession or trough cycle, but whether or not you should invest in that particular point of time is you will want some reassurance in terms of the market, the business potential, the market prospect, whether or not the management team is capable enough of putting company in a position where they will benefit from the sector recovery, the market recovery. That is the answer to whether or not you should invest at that low point. If the prospect is there, if the potential is there, and you found that the price is very low, and you are convinced that the management could turn things around, you could turn the business around. And
Hi, Shasni.
Yeah, Shane.
Sorry. Go ahead.
Oh, okay, yeah. So if you're convinced about the management could turn the companies around, turns their business around, make it the business more profitable, increase in revenue, increase in market share, benefit from the recovery trend, yeah, you could be rest assured to invest at that low point.
Okay. The next question is by Chua. Should we sell if the capital has dropped 50% if we didn't manage to cut loss earlier?
If that 50% is a discount, would you hold or would you leave the market? There's a different way of looking at this. Let's say the company is a very potential company, is really a good company, good business, very high prospect business, but then the 50% drop is because of, let's say, COVID, because of any market surprises, because of any market recession. Would you look at that 50% drop as a negative thing, or a chance, an opportunity for you to put in more position to increase your investment size? One example that maybe I should using an example would be more clear.
She gave an example at AirAsia. What do you think? Like, for example, AirAsia.
Okay. Are you convinced that AirAsia's Tony Fernandez will be able to turn things around? Do you think AirAsia will be able to step up from their PN17, even if they regain their market potential, they regain their profitability from the reopening of economies? Yes, their the business in the tourism business will be benefited, but will they be able to cater for their hefty debts, high level of debts? That goes back to how well you understand the business, how capable you think the management is. If they could turn things around, I think definitely current price is a very attractive price. No one could tell what will happen. No one could tell in what state Asia will be in the future, but it goes back to the business potential. It goes back to how capable the CEO, the management is in turning the business around. And also they invest heavily into their digital business. Do you think that puts them in a very good position in capturing future market potential? Those are the questions that you need to ask if you want to invest in Asia.
All right, so that conclude our Q&A session with Shasni. So thank you so much for doing this webinar for us, Shasni.
And you're welcome. You're most welcome.